No, Savan, current assets will not come. Current assets, as I told you, this is only about the long-term assets. The current assets will essentially come in your operating activity. I'll go there and I'll explain you all those stuff. Okay. So the purchase of fixed assets is 5.5 lakh rupees as of now. So your total cash flow from investing is minus 5.5 lakhs. All right. Now the only third activity which is remaining is cash flow from operating activity. But as of now, have you started your operations? Well, not really. As of now, all you have done is you have taken the cash and you went to the market and you bought the stuff. Okay. Since you have not started your operations, the cash flow from operating activity will be nothing, right? Except for one small thing, and that is you have bought some stuff which is essential to make your product. Okay. Now the stuff which you have bought as of now is going to be used in your production activity. That is the only single thing which you have done so far, which is according to the operations of the business. Okay, so that is the only thing which is going to come under this cash flow from operations head. So no operations as of now, but you bought 50,000 worth rupees of raw materials. All right. Now, if you have bought 50,000 rupees of raw materials, that is nothing but an operating activity. And since you have bought it, you took the money from the vault. It is again minus 50,000. All right. So total cash flow was 15 lakhs positive from financing activity, minus 5.5 from investing activity, and minus 0.5 from your operating activity. And hence the total cash flow becomes 9 crores. All right. Now, before I move forward, just give me a sense that whether this distinction is clear. Because if that is clear, then only we'll be able to make. Oh yeah, sorry, 9 lakhs. I'm sorry. Okay. We just keep on working on crores now. So yeah, sorry for that. It is 9 lakhs. All right. So is this clear? The whole idea? Any doubts so far? Just ask me. I mean. Okay, Savan Shishir just mentioned, whatever doubts you have. All right, so yeah, so I mean, just mention your doubts if anybody has any doubt. Yeah, I got the message. Yes. Amish, forget about changes in working capital. I don't want to go in the terminologies right now. I will do that once I move forward with the example. But don't worry, I'll cover that part. Yeah, so whoever has any doubt, cash flow from operation and finance keeps changing on when cash flow from operation and finance is changing based on the nature of the business. No, cash flow from finance is always, I mean, financing activity is nothing to do with the operations anyways. So there is no way it can keep on changing. All right. Now, once we move forward, I'll also explain you in that. So total cash flow is, just a second, I think the question went up. Total cash flow is the balance in the vault. The final number, yes, the final number will be your balance in the vault. So the number which you derive here, the 9 lakh rupees, yes, that will be your balance in the vault. All right, thanks for the compliment. Let's move forward. So this is the cash flow part. Now we've done the balance sheet, we have done the cash flow on day 4, day 5, whatever. Now let's go to the beginning of the operation. So let's assume that we are now starting our operations. All right, let's go to year 1 and start the operations. Now let's assume few things. In this whole 1 year, you sell few ice creams. Now the selling price of one ice cream is 25 rupees. Okay. I would also request you guys to just make notes side by side, because whenever you are doing the calculations later on, it will be very helpful for you people. Okay. So you sell one ice cream for 25 rupees. You take one ice cream, essentially making of one ice cream needs 10 rupees worth of stuff. Okay, so you bought that 50,000 rupees of inventory which you bought. For every one ice cream, you need 10 rupees worth of raw material. In first year, you sold 5,000 ice creams. Okay, so 5,000 ice creams. Well, not a very big number, some 400 odd ice creams per month you're selling as of now. Now let's start with this particular year. So let's assume that year 1 is over, and now you're sitting at the end of the year and you're doing your own accounts now. So you start with another blank page and you think, okay, in this 1 year, what have I made? All right, I've been working hard for 1 year. Let's see what I have made. So what have I made in the first year? Well, I write the revenues first. Okay, so I write the revenues. I sold 5,000 ice creams for 25 rupees each. I make 1,25,000 rupees in this particular year. All right, but well, don't only make revenues. I have also some expenses. So let me start by writing the expenses. Now, for one particular unit, it took me 10 rupees. I sold 5,000 rupees, 5,000 units. So essentially, my total raw material expense is going to be 50,000. All right. Now, employee cost. So as of now, the employees were not paid till now, but in the 1 year of my operations, I have paid these employees. Okay, as I told you initially, the employees are hired at a cost of 3.56 lakh rupees for 1 year. All right, pretty cheap labor. Then there's some miscellaneous expenses. So you did some free home delivery for which you have some fuel cost. Then you have some payments for the electricity bills. Then you have some repair going on for which you pay to the people. So all these expenses, I'm currently just making them combined in one factor called other miscellaneous expenses, or 50,000 rupees. Now, there is one another reason for me to do this particular kind of classification. That reason is simple, that whenever you are looking at quarterly results of the companies, generally the quarterly results will only include these 3 items. Okay, so when I was making the content for the webinar, I have also kept in mind what you're going to read on a regular basis. So make sure in your quarterly statements when you're reading, you will see this kind of a reporting. We'll have 3 major heads. First will be about all the things which are going in the making process of your product or services. Second is employee cost, and third will be other miscellaneous expenses, as I explained you, all the things which are not coming in the first 2 heads. All right. So after you remove these things, what remains is something called operating income. Okay. Now, operating income essentially means that from your operations, what have you made? Okay, you may have made some other payments, but as of now, from your yearly operations, what is the money you have made? You have 1,25,000 revenues, and you had all these expenses of 4.6 lakh rupees. Okay, so effectively your operating income comes to minus 3.35 lakhs. Yeah, it is a loss. All right. So in the accounting terms, we called operating income as EBITDA. So you keep on hearing about EBITDA and everything else. All right. So when you keep on hearing about all these stuff, I'm going to relate all the terms you listen to in the regular business papers or wherever with the example. So operating income is something we call EBITDA. All right. So EBITDA is what? The full form is earning before interest, depreciation, tax, and amortization. Okay, I'll be explaining all these terms later on, so don't worry about it. But as of now, this is called EBITDA. Now, coming to this example again, what have you made this year? You made a loss of minus 3.35. Okay, but is this the only expense you have borne in this particular year, or was there any other expense you have taken? You should have taken. Where to consider the rent of the shop? Assume there is no rent. I mean, that is there in the miscellaneous expenses. All right, yes, interest. I mean, no matter you make a loss or profit, that's a very good point. So, no matter you make loss or profit, you have to pay interest to the banker. That is very right. Sanjeev, depreciation. All right. So, what exactly is depreciation? Now, the key point here is that you took an expense like employee cost, like your power and fuel cost, your raw material cost, but there is something which you are also using, which essentially is your cost. But just because you are not now paying for it doesn't mean it wasn't a cost, right? What happened was that you paid for all your assets in one go on day one, but essentially you are still paying for it, for a certain part of it. So let's say if your assets are relevant for 3 years, whatever you paid for that particular asset is going to be your total expense for 3 years. So when you are making an account, what you do is you divide that particular total expense by 3 to come up with your this year expense, even though it is not exactly going out of your pocket now during the year. It has already gone. All right. So this particular concept is called depreciation. So as somebody said, interest, 10% you have to pay as interest. Taxes, well, not this year. You don't pay any taxes because you are in a loss. And as anybody said, depreciation. So you have been using your assets. A part of it is going to be something which is an expense for you, which will be taken as a depreciation. All right. Now, so depreciation, essentially people keep on calling it as a non-cash expense. It is true, it is a non-cash expense for that particular 1 year. Okay. But is depreciation effectively a non-cash thing? Well, not really, because essentially you are still taking the cash out of your pocket to build those assets at the very first place. So when you are doing that, you have taken the expense in one go. That doesn't make it a non-cash expense in the years when you are not actually putting the money out of your pocket. So Warren Buffett keeps on talking about, the stupidity of taking EBITDA numbers, because he has clearly mentioned depreciation, even though it is not a cash cost, it is still a real cost. All right. So just make sure that you understand this concept of depreciation. Now, in our case, let's assume that all the questions which you people are writing, I'll just take it the moment this explanation is finished. Okay, so don't worry about it. So the depreciation, assuming your assets are for 5 years, your value of asset which you're going to use in 1 year comes out to around 1.1 lakhs. Okay, so this year also 1.1 lakh rupees worth of assets you have used. All right, so depreciation becomes 1.1 lakhs. So how does my profit and loss account looks like? There is minus 3.35 lakhs worth of loss which I took only from my operation without even considering my sources of finance or sources of funds or depreciation. So that number is minus 3.35. Now if I remove my interest and depreciation from it, my final loss comes around minus 4.95 lakh rupees. A pretty huge loss. Imagining you just had 15 lakhs rupees worth of capital in very few assets. All right. So yeah, I mean, thank God we kept some cash, right? So if we wouldn't have raised all that money, as of now, during the year only, I would have probably given up, and my my business would be closed if I don't have capital. So this also mentions the importance of having some short-term liquid cash with you or liquid money with you. All right, again, I'll build on the example later on, but the key idea is remember that in bad years, you should have some kind of cushion with you. In our case, the cushion was the cash which we have. Okay, in some cases, it can be something else. So again, the idea here is that you should have some cushion. All right, now before I go forward, let me just take all the doubts which are there on the right side on the chat column. Okay, so Srini asked me, our salaries also should be considered. Well, yes, but considering most of the entrepreneurs when they start, they don't take salaries. But when I say employee cost, assume every employee cost is taken in this. So whenever I start taking the salary, well, yes, I'll take the owner's salary in that only. Yes. Suppose it is the revenue I have not received money from a customer. Well, as of now, you're just selling in cash. Okay, I will cover all those points. Don't worry about it. It's an essential component. Employee cost is high for capital of 15 lakhs. Well, you have to start somewhere. All right. So in software companies, all the costs are employee cost. Would the balance sheet can be derived from quarterly statements? I'm particularly interested in knowing how inventories are changed. Well, it is very difficult to do that for a simple reason. I mean, you can get a rough sense of the balance sheet, but you cannot really come on the application of fund side from quarterly. But nowadays we do get half yearly balance sheet, so essentially that part is pretty much covered. Quarterly balance sheet, well, it is very, very difficult to make them. I mean, even if you do try to do that, you will have a tough time, coming up with even close numbers. Application of the fund size will be difficult. Sources of the fund size, yes, you can derive. So whenever I do ROC calculations, I do take into consideration the quarterly numbers. I will explain you, Shigar, if that's the point you're asking. Okay, can cash flow from questions? Okay, I'll cover all these points. Okay, later on I'll cover all these points. So let us finish first this part. So financial condition after 1 year. So now what has happened so far? 1 year is gone, and in this 1 year, you did some kind of business activity. You know your position when you started the business. After 1 year, you are supposed to now sit and make the same page you made, which was 5 days from the initial part of your 5 days in the initial part of your business. All right. So now you sit and again you start making this snapshot of the company. All right. Now, one simple thing is, in this whole year, have I raised any money from anybody? Have I paid any money to anybody? Well, not really. Okay. So does my sources of funds change? Well, not really. My sources of funds won't change. But what about the application of funds? Okay. Now, in the application of funds, remember we have some inventory when we started. So we had 50,000 rupees of inventory. In this year, what I did, I went to the storeroom, I took up the raw material and I started making my product. Okay. Now, luckily for me, in this year, the only amount which I required was available in my storeroom. So did I go out and buy something? No, really. Everything was there in my inventory. Okay. So I needed 50,000 worth of raw material and I got 50,000 worth of raw material from my inventory only. Okay. So my inventory now is zero. There is nothing remaining in my store. Everything which was there is now consumed. Okay. Now let's go to the fixed assets. What is the fixed assets? Well, I started with the value of those assets at 5.5 lakh rupees, right? But as I explained you, some part of this asset is used in this particular year. Okay. So the fixed assets which remain on my balance sheet are not going to be the same as when they started out. Some part has already been used as a form of depreciation. Okay. So this 5.5 lakh rupees, which is the initial purchase price of your assets, in the actual balance sheets of the company, you will see this number as gross block. 1.1 lakh will be shown as depreciation. So the remaining amount, which is 4.4 lakhs, is something which is called the net block. All right. So the value of the assets today, after year 1, when you're sitting and you're looking at your company, if you go and see, okay, my assets are now worth 4.4 lakh rupees, not 5.5 lakh rupees, because I have used some of these assets. All right. Now, cash was 9 lakh rupees when I started my business. Now, what I want you to very carefully understand here is that what happens to my cash position as and when I go about my business activities. So in this year 1, when I started, I had cash of 9 lakh rupees. Okay. Now what happened after that? Well, I made a revenue of 1.25 lakhs. Right? I made 1.25 lakh revenue. 3.6 lakhs I had to pay for my employees. 50,000 were paid for my miscellaneous expenses. Remember, so if your P&L statement which you saw that time, which your paper you made, in that P&L statement, 1.25 was your revenue. Your raw material is completely sourced from your inventory. So there is no raw material coming from anywhere. There is no cash going out of your vault. The only thing which is going out is the storeroom inventory, which you have been using for raw material. 3.6 lakhs went from your vault to pay the employees, and 50,000 rupees went for other miscellaneous expenses. Okay. Is there any other cash you have taken out of your vault? Well, you have also paid 50,000 rupees as an interest component to your bank. Okay. So 50,000 rupees went as so that money also came from your vault. Any other cash you have done? Well, 1.1 lakh rupees of depreciation you have already accounted for in your fixed assets. So, and anyways, that is not a cash going out of your vault. Okay. So is there any other cash expense you have done? Have you paid any taxes? Well, no. You have not paid any taxes this year. So we have taken all the cash expenses which we did this particular year. So what is my final cash number? 5.65. All right. Is there anything else that has happened in this year? So we took raw material, we covered raw material, we covered employee cost, we covered other miscellaneous expenses. we covered depreciation, we covered interest. Is there anything else which is remaining this particular year? Nothing has happened, right? So what happened in this after 1 year? The value of my asset went down, my inventory went down, the cash 9 lakh rupees has now gone to 5.65. Why it has gone down? Because I was supposed to get more money because of my revenues, but I didn't made any revenue this year. So my cash position also went down. So essentially what happened? All the assets which were there on the application of fund sides, they got shrinked. Alright, now let's go to the sources of fund side. What happens now? Your debt is 5 lakh rupees. Does the debt amount change? Well, no. Why would that amount change? You have paid an interest, but you have not repaid the loan as of now. The only thing which you have paid is the cost of the debt, not the debt itself. Okay, so you have not paid any money towards the repayment of debt. But what happens to your owner's money? When you started, the owner's money was 10 lakh rupees. Alright, but if I do that, can you see the total of the sources of funds is 15 lakh rupees and application of fund is 10.05 lakh rupees. Why is that so? For a simple reason. When I'm running a business, whatever profits I make is also mine, whatever loss I make is also mine. Okay, as an owner. Okay, so whenever after 1 year you make an account, the loss of the particular P&L account or the profit of the particular P&L account goes and comes, it gets added to my total net worth, which is my owner's wealth. Alright, so in this year I actually made a loss. If I take that loss and I add it here, which is minus 4.95 lakhs, my owner's wealth number changes to 5.05 lakhs. So now my balance sheet will look balanced. Okay, so one thing which I always want you to do is that look at equity, or which is the owner's wealth number, as a balancing figure. Debt is an actual activity. These all things you can come up with. If you start looking at equity as a balancing figure, it will really help you later on. Now how will it help you? I'll explain later on, but just remember this term, just remember the term, equity as a balancing figure. Alright, now just a small revision of point here is that whatever number which you come up with in terms of profit or loss after your 1 year of work, 1 year of efforts, which is what we call the profit and loss account, that last number is going to be added to the owner's money, owner's wealth. In the accounting term, this number is also called shareholders' equity. Okay, now let me take your questions. So doesn't the interest include a piece of capital too, like we do in the EMI for housing? Yes, Sridhar, it's possible. But when we say interest component in case of companies, interest is only interest. Okay, the other part is called repayment of debt, and that is taken separately. We don't really route it through P&L, profit and loss account. But yeah, you're right. When you do in EMI includes both principal repayment as well as interest repayment, but not in case of companies. Any other questions? Shankar, I'll take that question slightly later. That is a slightly more technical questions. How did you get minus 4.95 lakhs? That was my final loss number. If I take you back, this number, net loss. All right. This number. Okay. So what about venture capital? Is it a debt or equity? Well, venture capital gives you money both ways. Generally, it is equity. Just hold on. There is some issue here. Just hold on. Now it doesn't matter where the loan are coming from. Is it from relatives or from or from bank, loans are loans. So essentially you have to pay. But if you're asking me the legality of it, well, generally there are issues when it comes to the, accountings, no interest for them. Well, that's not true. I mean, again, that's the whole idea. Now, generally, interest is something which you decide with your lender. All right. Now, if you're looking at a particular company and it has taken some loan from somebody which is interest free, right? Well, frankly, it tells you, the corporate governance of that particular company. Now, generally, you do not get interest-free loans. So, what happens is one of the parties is losing in the whole scenario. The first party may be losing if it's giving interest-free loan. The second party is losing when it is giving in loans. For example, if you as a company give loan to somebody which is interest-free, the shareholders of this company are going to lose money. Equity of balanced figure is a good indicator. Is that a net or after taxes under which component is considered? I'll explain you all those things. Let me just get into the consideration, all the tax part and everything else, right? Why analysts or investors look more for debt-free companies? Essentially because if you do come into a position where you have some tough year, okay, your losses get accentuated because of debt. Why? Because you have to pay interest. If you are the owner, and a lot of owners, as an owner you can, if you don't make money, you don't get money. It's as simple as that. But if you are a bank who has given loan to somebody, it doesn't matter whether the other person is making money or not, you will have to pay loan. But in the initial part, I don't know whether you were there or not, but in the initial part I mentioned that manageable debt is not bad. Manageable debt is actually a good thing. Okay, so what is manageable? Well, depends on the nature of the business. So companies which have volatile businesses, that should be as low as possible. If a company is in a very consistent businesses, there's some part of debt which is easily manageable, which should be there on the balance sheet. All right, so let me move forward. So this part is clear to you? Financial condition after 1 year. Now, what I want you to do is, I want you to go to the initial discussions and start looking at the cash flow numbers, yourself. Now, why I want you to do this is simple. I will obviously explain it side by side, but the more you do it in your own pen and paper, you'll be able to relate to the whole idea. Now, what is cash flow from operations in this particular case? Okay, let me do one thing. Let me skip cash flow from operations. Why to do the difficult things, right? Let's do the easy part first. What is my cash flow from financing activity? Sorry, investing activity. Did I take any money this year? Did I raise any capital? Well, not. Right? So this particular year I didn't raise any money. So my financing activity is 0. Right? But did I repay something? Well, I didn't repay any debt for sure. Did I repay anything else? Well, I paid some interest, right? So interest is, why am I paying the interest? Because I have taken some kind of loan from somebody. So since I have a financing activity done throughout this, in my business as of now, which is debt capital, my interest paid is going to be a reason. Why am I paying the interest? The cause of this particular activity is my action of taking loan. Since my action of taking loan is a financing activity, the cause is also going to be financing activity. It's a financing activity. The cause is also going to be a financing activity. All right.